Would you invest in a tourism stock with over 3.5 billion Singapore dollars in cash, almost zero debt, and a premium resort undergoing billion-dollar transformation? Welcome to Durian Finance here. You'll learn how to grow your money, decode the stock market, and build wealth, no jargon. Subscribe now and never miss a winning stock idea. Genting Singapore, listed under the ticker symbol G13, in Singapore Stock Exchange, owns Resorts World Sentosa, one of Asia's largest integrated resorts. From casino gaming to Universal Studios Singapore and the new Oceanarium, this is more than just a tourism play. This video is for educational and entertainment purposes only. It is not financial advice. Please conduct your own research or speak with a licensed financial advisor before making an investment decision. With a 22% profit margin and near zero debt, is this Singapore's ultimate defensive stock? Let's talk numbers. Genting Singapore pulled in a massive 2.53 billion Singapore dollars in revenue for 2024, marking a solid 5% year-on-year growth. Even better, they banked a net profit of 578.9 million Singapore dollars, proving the business is both scalable and profitable. And get this, they're sitting on a cash pile of 3.59 billion Singapore dollars with almost no debt. Their debt-to-equity ratio? A shockingly low 0.04%. Here's the kicker. They could literally buy back half their shares with cash alone. So why isn't everyone talking about this stock? Now here's where it gets really exciting. Genting Singapore isn't just coasting on past success. They're going full throttle into the future with RWS 2.0, a multi-billion-dollar transformation that will redefine Singapore's tourism landscape. We're talking about brand new luxury hotels, a 4-story retail and dining paradise, and jaw-dropping attractions like Minion Land, the first of its kind in Southeast Asia. Plus, the current SEA Aquarium will evolve into the massive Singapore Oceanarium, tripling in size and showcasing deep ocean ecosystems like never before. Rollout begins February 2025, with a full completion target set for 2030, and the best part? All the groundwork is already in motion. Let's talk about one of the sweetest words in investing, dividends. In FY 2024, Genting Singapore rewarded shareholders with 4 cents per share in dividends, up from 3.5 cents a year before. That's a 14.3% increase year-on-year. Not bad for a stock with growth ambitions. At current prices, that works out to a dividend yield of around 5.8%, easily beating most local bank savings accounts. Money bag, and here's the real kicker. These payouts are backed by 260 million Singapore dollars in levered free cash flow. With a payout ratio just under 45%, there's still plenty of room for reinvestment or even future increases. For a company sitting on over 3.5 billion Singapore dollars in cash and virtually no debt, this dividend is not just stable, it's rock solid. It's the kind of stock that pays you while you wait for long-term capital gains. A growing dividend and billions in cash? Yes, please. From a valuation standpoint, Genting Singapore looks quietly undervalued. Its price-to-earnings ratio sits at just 14.6, right in line with market averages. Yet this is a premium tourism and entertainment brand with dominant IPs and a billion-dollar expansion on the way. The price-to-book ratio? Just 1.02. That means you're essentially buying the business at near asset value, with minimal premium priced in for future upside. And get this, the PEG ratio, which is just for growth, is only 2.18. That's fair, even attractive, for a company that offers both capital appreciation and consistent dividend yield. Compared to global players like Las Vegas Sands or Wynn Resorts, both with higher multiples and heavier debt, Genting looks like a rare bargain. So why is it still flying under the radar? Maybe not for long. Now let's zoom out and look at the big picture. Tourism is roaring back. In 2024, Singapore welcomed 16.5 million international visitors, a 21% surge year-on-year, and it's well on track to surpass the pre-pandemic peak of 19.1 million seen in 2019. Tourism receipts are also on the rise, projected to exceed the 27.7 billion Singapore dollar record from before COVID-19. For a company like Genting Singapore, which owns and operates Resorts World Sentosa, a premier tourist destination, that's a direct growth engine. With attractions like Universal Studios, the upcoming Oceanarium, and a revitalized hotel portfolio, RWS is positioned to capture a significant share of both tourist dollars and foot traffic. As tourists return, so do profits. Are you positioned to ride the wave? Priced like a slow mover, but gearing up for rocket speed growth. When it comes to brand power and competitive moat, Genting Singapore is in a league of its own. For 10 consecutive years, Resorts World Sentosa has clinched the title of Best Integrated Resort in Asia, a rare achievement that speaks volumes about its consistency and dominance. But it's not just about awards. It's about world-class content and experiences. Genting has secured exclusive partnerships with global entertainment giants. Think Harry Potter, Visions of Magic, Minion Land, Pokemon Aqua Adventure, Netflix's Sweet Home, and Genshin Impact. These aren't seasonal pop-ups. They're strategic crowd pullers that drive traffic year-round. Add to that the SCA Aquarium, ranked among the world's largest oceanariums, the Michelin-starred ocean restaurant, and iconic events like Ocean Fest. And you got a destination that people don't just visit once, they return to. Beyond its physical transformation, Genting Singapore is playing a smart long game, forging powerful partnerships that amplify its reach and relevance. In 2024, it signed a multilateral memorandum of understanding with Sentosa Development Corporation, the Singapore Tourism Board, and DBS Bank. This landmark collaboration, called the Sentosa Precinct Partnership, aims to reimagine the entire Sentosa ecosystem, blending tourism, sustainability, and finance to turn the island into Asia's most compelling leisure destination. And that's not just talk. Resorts World Sentosa has already proven it can deliver world-class experiences, having hosted some of the biggest international events in 2024. The 2024 FIDE World Chess Championship, held for the first time in Singapore, drew over 7,000 fans over 14 days to witness a showdown between global chess titans. It also welcomed the Global Sustainable Tourism Conference, GSTC, showcasing RWS's leadership in ESG practices. And for fans of pop culture, Jackson Wang's live event and concerts by Westlife and Air Supply lit up the calendar. But Genting isn't stopping there. The resort has also planted its flag in the growing world of esports, hosting the Blast Premier World Finals, where 8 of the world's best Counter-Strike teams competed for a $1 million prize pool. Over 10,000 fans showed up to witness the action live. Now let's talk risk, because no investment comes without challenges. In 2024, Genting Singapore's adjusted EBITDA fell by 6%, largely due to rising operating costs and inflationary pressures across labor, utilities, and materials. And like many global travel and entertainment stocks, Genting faces broader headwinds. Global meridians including geopolitical tensions, macroeconomic uncertainty, and a stronger Singapore dollar, which can dampen foreign visitor spending. But here's the silver lining. Genting isn't overly exposed to any one risk. With a diversified revenue model spanning casinos, theme parks, luxury hotels, MICE events, and F&B, the business has multiple engines running. And let's not forget that 3.59 billion Singapore dollars in cash sitting on the balance sheet. That kind of war chest allows Genting to weather storms, seize opportunities, and continue investing aggressively in its RWS 2.0 transformation. Now, about the casino license, a concern on many investors' minds. The Singapore government renewed Genting's casino license in November 2024, reaffirming its trust in the group's compliance, governance, and contribution to national tourism. While licenses are reviewed periodically, Genting's strong track record, commitment to responsible gaming, and deep government partnerships make the risk of non-renewal extremely low as expected. Genting Singapore offers solid financials, future growth via RWS 2.0, and strong ESG credentials. It's a rare mix of dividend, growth, and defensive strength. If you like this deep dive, check out our video on Singapore's best dividend-paying REITs next. You'll want to add them to your watch list. Subscribe now. Next video, we reveal 3 stocks insiders are secretly buying.